I'm Feras, and so if I haven't met you, I would love to meet you. So please come talk to me. I'm very personable, very social. I'd like to try to get to know everybody in the room, but I'll let them kind of get the slides on the screen. But, like Bronson said, my background is software. So who here came from a tech background? 25% of the room, right? And then another 10% that's too nervous because they're tech guys to begin with, right? And so, I like to tell people tech is a natural fit for real estate. You see a lot of people in it. Why? Right? Because tech people typically have a little bit of disposable income, but more importantly, right, real estate is about numbers, systems, processes, people, right? And it's the things that I genuinely enjoy. And so a lot of tech people kind of hop right in, and you're doing the right first step, which is just getting to learn the industry, right? And I tell people, take it slow, don't go all in, go out there and get educated, go out there and network, go out there and learn from other people, right? You learn from other people's mistakes. And so, hey Bronson, you want to get the slides? But I'll keep talking. So I know there's a slide on here. The next one really talks about the company. So I'm one of the managing partners of Disrupt Equity. I have a 50-50 partner, Ben Suttles, who I'll have a picture on later as well. But we started Disrupt Equity many years ago with the idea of, hey, how do we use a lot more tech to modernize the industry, do a lot more than others, right? And so today we've done, I think, over $800 million in acquisitions, over 6,000 units. And it's been a whirlwind, right? And it's about people. That's the thing you learn, right? Whether you're doing just a deal and you're handing off the third-party management or you're doing your own management, you start to learn that to be successful in this business, real estate is a very people-oriented business. And that's where going out to events like this, networking, talking to the people in your, at your table, going find complementary sets of skills is how you can grow together, right? You grow together first, and then on top of that, you need to get a team that is motivated and successful to actually go out and accomplish your goals and stuff. Let's see, is this up? I think it's still, the clicker keeps on switching off the, no worries, all right. But just kind of keep going down that thought process. So, Disrupt Equity, we have about over 200 employees. We broke this year, and last year we're number one fastest growing company on Forbes in Houston. So, super shocked, never really expected to see what it is, and I'd like to tell the team we're just 5% in our journey and where we're going. And so today I'm going to talk about really just kind of the risks in commercial real estate, right? There's a lot that goes on to these properties, and I think most people forget that you're not just buying an apartment complex. You are buying a multi-million-dollar business. And do you understand that? Do you think that way? Do you understand the risks? And a lot of what I'm going to talk about is really things that have happened from my experiences. And so really talking through the good, the bad, the ugly. And for those that know me, I'm a very candid guy. I'm happy to share good, bad, and ugly, right? And I'm going to talk about just some of the things that we've encountered, some of the ways to think about it, and some of the things that people talk about very often that people, don't know how to think about. And so let's see the slides here in a second, but I guess a little bit more about my journey because I know I have a slide about that. So my first piece of real estate I ever bought in my life. So as I said, my background is software. I was at Microsoft. I interned, then I went full-time, and then I left Microsoft and had a software company. And I was starting to get into just real estate investing, just wanting to figure out, hey, how do I, invest my money? I bought a fourplex, which I have a picture up here, which is my first piece of real estate I ever bought in my life. I think, is this going? And toured this property, right? And I just remember their takeaway was like, do you know what the heck you're doing? And I'm like, yeah, the numbers make sense, right? So bought that property, turned out to be a mediocre area. You start to learn that area matters and it makes your job a lot easier, right? And so for those that are in Houston or even really Texas, fourplexes are rare, right? Houston is so cheap. We don't build up, we build out, right? And so it's hard to find fourplexes. I ended up buying a bunch of houses. That was the first rental, which is one of the few pieces of real estate I still own to this day. I've had the same tenant there for like 6 years, doesn't ask a single question. It's been a walk in the park, right? But then really I'm going to talk about this deal. So, I kind of scaled up, got to 13 units or so, 13 properties, and realized that freaking rentals suck, right? It does not scale. Yes, you could be successful in real estate, and I tell people, real estate, there's not a right or wrong way to do it. It's about having a plan and executing, right? And again, if you want to go get 100 rentals, by all means, go do it. But for me, I didn't like the single-family stuff because, again, you got like 13 insurance policies, you got 13 loans. Loans get sold to different companies, so that constantly changes, and it was just a little bit of a grind. And so ultimately, was going to get into apartments, was going to go do my own 32-unit deal in Conroe, which is a submarket in North Houston. I'm glad I didn't win that deal. Still friends with the broker this day, but ended up, fast forwarding, met my partner Ben at a meetup, right? And so that's why I say these things work. And so everybody's goal in this room should be to talk to as many people as you can. And I like to tell people, you're not here for what I'm saying. Like, you'll learn something from what me and the other speakers are saying, But really, the most valuable thing you can do is meeting somebody here that has complementary skill sets, and guys go accomplish something bigger, better together, right? And so please make sure you get out there and network. But ultimately, I met my partner, Ben. This is a 99-unit deal in Atlanta, and I'm going to talk a lot about this because, again, we're both smiling on that, but that was at the end of the day. I remember at the beginning of the day, my partner was like, what the heck are we going to buy? Because this thing was just a rough deal in a rough area. And the rest of the deal, we had a clear pathway to what we could make it, but it was just poorly managed. And I just remember whenever we were doing our due diligence, there's the backside of the property is up to the woods. And there was literally a tenant throwing bags of trash out of their balcony on the third floor into the woods. And the tree looked like a Christmas tree, just a bunch of things hanging from it. And so, but by the end of the day, I think my partner kind of started to see, okay, the opportunity, right? He's a lot more reactive than me, I had to kind of warm him up and get him more comfortable with it, but we were smiling by the end of the day. But little did we know that, we were going to learn a lot of good, bad, and ugly from this property, right? And ultimately, we were successful with this property. We ended up selling it, I think, 18 months in and got our investors 80% return on that deal, right? But we learned everything that can go wrong and all the things to make sure we don't do again on all of our future deals from that first one. And so again, first thing to talk about, right, first risk is just buying in the wrong market, right? You hear that a lot, location, 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 and whenever you start analyzing deals, you might start to say, well, the numbers still justify a better or a worse market. But again, your job as an investor is to continuously de-risk the investment, right? That is the number one thing. And how do you de-risk the investment? Well, it starts with picking markets that are easy for you. Who here invests in Detroit? Nobody. Right? You can make money in Detroit, right? You can make money in any market in Texas, any market in the country. But again, it's about how hard do you want to work or how much risk do you want to take on. Some of our most successful deals that we've actually had are deals in Beaumont, Texas, which is about an hour east of Houston. But again, that's a riskier market for a lot of different reasons. And so buying in the wrong market makes your job harder. You want to figure out a way to buy in markets that continuously make your job easier. Because even if you do a poor job on the property, right, the market can help it correct you for some of that. And the flip side too, if you're buying in tough markets and then you falter on the execution, well, now you get a compounding effect, right? And so location matters, and that's both macro and micro, right? You really want to start to think about where you're buying and understand your submarket. I like to tell people, go out there and tour the property, but come back at night. The night is where you see the most things ever. And I'll tell you guys one story. So once we started our management company, one of the things I learned from the management team that they do basically first day of any property, take over the property, then at nighttime they do what's called a night light check. And what are they looking for? Well, they're trying to see which tenants have changed the colors of their bulbs, right? Because that is a way that they essentially market to their audiences. If it's green, that person is probably dealing drugs. If it's pink, it's probably, prostitution, things like that on some of these different deals. And so go out there, drive your properties, drive them at night, because that is whenever you really see. Don't go just during the day whenever the broker has a perfectly set up tour for you. Go there at night and get to understand the deal and drive the other deals in the area as well so you can understand, is it a market that you want to be in, right? And again, it's not a right or wrong, but it's about going in eyes wide open and knowing what to expect in any deal, right? And so that's one thing. Next up, right? Really talking about just overpaying for an asset. Basis matters. And I see this all the time where people get fixated in modeling a deal, right? Because we have an acquisition team. We have 5-6 people on that team. And they'll bring a deal where, hey, the returns model out. It looks like it's going to make sense on paper. But then you kind of have to back them off and say, does it feel right, right? Ultimately, does the price per pound make sense? Even if you can get the returns that you think you can get on the deal, you still want to make sure you're buying deals at market or below discount, right? And so you see this a lot where, hey, a deal, maybe you can buy it for $200,000 a door and the numbers make sense where it's a good enough, IRR, good enough return for investors, but the basis is too high. Every deal that market and similar assets should be going for $160. So you really need to be okay to say no to those deals, because time and time again, and that's how a lot of people get in the situations that you're seeing now, right? Where the basis, they kind of ignored the basis, the numbers made sense, but then, market shifts and now you're kind of stuck in a bind. Right? So basis really matters, and really that is one of the biggest things. It makes your life easier on the exit, right? Then you don't have to hold the deal forever until the market maybe corrects it. Right, next up, not having enough cash. And so this was the first big thing we learned, right? Who here thinks reserves matter on a property? Hopefully everybody raises your hand. Well, you should really have so much more in reserves than you can even imagine, right? And on that property, we thought we were doing $1.1 million of upgrades. we made the mistake on that property by getting the lender from hell, right? You start to learn, like, the lender is your biggest partner on a deal. They really are. And on that deal, that first one, the lender was basically what's known as a loan-to-own shop, right? Their goal was to do the deal, try to see if they can get you to default, and they can take back over the deal. And on that deal, they literally came out at the property and said it's one of the best turnarounds they had seen. Because, that deal, we completely cleaned it up. Day one, brought on armed security, really started to clean out and get high-quality tenants, started to improve the asset, put in playgrounds, put in dog parks, and really turned it around. And the landlord, the lenders saw that, and they said, best turnaround they've ever seen. But at the same time, you submit a draw for $500,000, and they don't want to approve it. And they're constantly giving you reasons, because the way a lot of this works is basically you fund the deal out of your own pockets, right, from your reserves, to do some upgrades. Then the lender verifies the upgrades are done, then they'll give you that money, and then you go do the next set. Well, if the lender's not giving you the money, you get stuck in a bind, right? And on this lender, we didn't know that they were a loan-to-own shop, but their intention was very much to see if we could falter, right? Because whenever with this deal, we took it from 80% occupancy on paper down to 40%, then back up to 95%. And I promise you, whenever you're at 40%, you're losing money, right? And so it's stressful. You're like, all right, we're losing $30,000 a month. Like, we got to get this thing stabilized and up and running, right? The lender knows that, and they're like, let's drag this loan approval out, right? Just to keep it in the negative longer. And even to the point where they had basically made a deal with us to say, if you did X, Y, and Z, we would release the loan, the draw. We did X, Y, and Z, and then they came back and then said, well, our partners on the deal did not approve that deal. And I'm like, how are you cutting deals with us, the stuff that's not even approved on your side, right? And so reserves matter. And this is something we've taken to heart. Every single one of our deals, we have so much more ample reserves than what we even think we need. We literally model it all out, we get a number, and then we basically 2.5x it, right? Because ultimately it is better to reduce risk. Again, it goes back to what I said earlier. Anybody buying real estate, their job is to mitigate risk. You can buy a terrible deal and still mitigate risk and come out okay, right? But you need to keep that in top of your mind, and the ways you mitigate risk is having plenty of reserves. Your investors will not be disappointed if you got them a lower return because you raised more equity, right, than if you would have lost their money to begin with. And you're seeing that now, right? There's a lot going on in the market. A lot of these deals are doing cash calls and or they're getting foreclosed on, right? And I think the next 120 days are going to be very, very interesting, right? But reserves, and this is what has saved us time and time again. Right? You can predict everything, plan for everything, but things still go wrong, whether it's market, whether it's vendors, whether it's other just operational problems, right? And so having enough cash will make your life easier, and always, always, always err on having more than less, right? Next up is the wrong capital stack. And so I like to say real estate is financial engineering. That's why it goes back to earlier, I said, tech people tend to gravitate towards it because it's numbers. Having the wrong capital stack can make your life great, or I guess having the wrong one can make your life terrible. Having the right capital stack can make your life great. And it's really understanding, and it's not that there's a right or wrong, and I want to stress that. It's not that floating rate debt is terrible, you should never do floating rate debt. It adds a level of risk, but then there's trade-offs for it, right? And so really wrong capital stack is something to kind of keep in mind and really make sure you understand what your different ripcords are, right? How do you continue to mitigate risk? How do you continue to structure the deal to have different options to get out of? And so again, on all of our, we've done several deals floating rate debt. Every single one of them, we bought really tight caps. So now that the interest rates are high, we're still sitting good. And on top of that, we bought long-term. There's one deal that I feel like a genius because we bought a 5-year cap. I thought it was a 3-year cap and realized that it was a 5-year cap. And we bought that thing for $35,000. And today that thing is paying us $30,000 every month for the next 3 years, right? Next up, continuing on. So, right, permanent versus bridge. This is the same one, right? But there are, there's permanent debt, there's bridge debt. I'm not going to spend too much time because I think I have 10 minutes, so I'm going to kind of gloss over this. But again, there's not a right or wrong, and I want to stress that. There's a lot of negative stigma with bridge debt, but it's called bridge for a reason. It's meant to bridge you to the next thing. So don't take on bridge debt as if it's fixed permanent debt that's going to basically let you buy a deal at a much higher price per point, going back to my first example of the wrong basis. And then you're stuck in 3 years where, hey, you didn't get the NOI push, you didn't do any value add, you didn't really accomplish the goals, and now even your permanent debt looks bad, right? All right, next up, rising interest rates. And so this is the elephant in the room. Everybody's talking about it. And again, there's ways to mitigate for it, right? Right now, we're buying 4 deals that we're buying on fixed rate debt assumptions, where we're basically going to buy the deal and keep the debt that's already in place because it's nice debt. One of the deals is 3.8% interest, 7 years interest only for the next 7 years, right? That's one way to, kind of work through higher rates. The other side of it is, as you're buying deals, those rate caps matter. Who here doesn't know what a rate cap is? Everybody knows. All right, I'm not going to talk about if everybody knows what it is, all right? I guess it's the Advanced Real Estate Summit for a reason, right? And so really understand, though, the strikes on your rate caps, right? Because those do matter. A lot of people will just do the bare minimum the lender requires. And there's a client that we third-party managed today that I was talking to, earlier this week. They only bought a 2-year cap, not a 3-year, and they bought it really loose. And so they are getting killed on interest, right? And so again, really understand that, and the more important thing too is understand, if you do have bridge debt, what your triggers are for those extensions, what your triggers are to be able to get out of those loans, right? There are a lot of covenants, and again, it's what I said earlier, the lender is your biggest partner. Next up, insurance, right? This one matters too. And again, I have a real world example of this going on right now on a property that we third party manage, where, essentially the insurance they had in place went with the cheapest option, did not have an assault and battery, it had an assault and battery exclusion. Well, an assault happened at the property, there's a big lawsuit, and their insurance is not going to cover it, right? And that's on a third-party deal. So again, make sure you have good quality insurance and understanding the risks. If you're in a flood zone, spend a couple $1,000s to buy a flood policy. We had a property in Beaumont that flooded, and this policy cost us, I want to say, like $40,000, and that thing paid us out $3-point-something million because of the flood that happened, right? That money, that $40,000 is a rounding error, but it reduces risk. So are people seeing the theme of what I'm saying? It's about constantly doing things to reduce risk with what you're doing. Oops, did I skip that? There we go. Yeah, that one. All right, property taxes. Especially if you're in Texas, taxes suck, right? They go up every year. You need to know that, you need to plan for that. And right now it's kind of interesting because you can buy deals today that are at a purchase price below what they're being appraised at. So you can actually model it lower. So you might be buying a deal that is currently being appraised at a $50 million valuation, but I'm buying it for $40 million, and I know I can go walk into the tax office and say, hey, here's a statement. It was bought for $40 million. But you need to understand taxes, and it's different per market, right? One of the things I loved about Atlanta, so for us, our big markets were Atlanta and Texas. And Atlanta, you're assessed at 40% of the appraisal. So even if you make a mistake on what you think it's going to be appraised at, your margin for error is 40%. And then on top of that, they don't reassess every year. Whereas Texas is the other side of the spectrum. Every single year they're reassessing, trying to push it higher, and you have to really be aware of that and play with that, right? And so I think, between this slide and the previous slide, insurance, those are the two biggest things killing deals this year. Insurance and taxes have gone sky high in Texas, sky high in Florida. But again, you have to plan for it, you model it out, and you work through it. And one other kind of benefit, and this is totally worth the entire conference, which is you're only supposed to be taxed on, bricks, sticks, and land. And so what does that mean? If you're buying a property, and let's say it has $1 million of appliances inside the property, if you know what you're doing, you can actually go back and say, hey, that shouldn't be taxed. That's not part of the real estate. That's a different component altogether. So again, that's where having the right cost segregation, the right team that knows what they're doing can help you significantly. And so go out there and talk to these vendors, right? All right, next up is just know who you're investing with. The biggest problem with real estate is there's a lot of smoke and mirrors, people, right? Understand who you're investing with, understanding what their backgrounds are. Is it their focus? Is it their not? What have they truly done, right? And what has done, what have they done mean, right? Were they active? Were they passive? I mean, you see this, and some people will really, really skew the numbers in their favor. And I think this is really one of the biggest challenges in our industry, is that there's a lot of smoke and mirrors, and investors go in eyes wide open and basically investing with people that they don't really realize, kind of that there's a lot of greatness to what they're saying, right? And so again, you're backing the jockey, not the horse, right? In this business, like a good operator can take a mediocre deal and still do okay, but a bad operator, and I've seen it many, many times again, where they'll take a good deal and really screw it up, right? And the thing, as I said earlier, is operations matter. Right? Like that is the hardest part of the business. Everybody focuses on how do you buy the deal, how do you raise the money, but that's actually the easiest part of the business. The hardest part is how do you operate the deal, right? And we created our own management company several years ago because again, most of these management companies were piss poor, and it put things backwards. And it's about we need to have the hands-on ability to get in there, make the changes we need immediately, and really micromanage that process. And so operations matter, and if you're buying a deal, if it's your first one, realize like the buy is the easiest part of it. Do not pump the brakes after you buy the deal, hand it off to another company, and check out. Right? And then, next, last but not least, right, the macro economy. Understand what's going on, and don't be the guy that goes to every conference and never does a deal for 10 years. I see those people, right? Don't be that person, right? You're not there to buy at the bottom of the market. You're not there to buy at the top of the market because you don't know when bottom is. You don't know when top is, right? It's about finding the right deal that makes sense for you and your investment strategy, mitigate the risk, and ride it out, right? Time in the deal is better than timing the deal, and that's very, very true in real estate. And so, like I say, it's about really understanding what's going on, big picture, have a strategy, and work towards it. So, that said, I think I'm right on time. So, that's me. I'm happy to open up for Q&A for a couple minutes at the end. That's my contact information. Feel free to send me an email, check us out. Happy to help answer questions. And if anyone has Q&A right now, I'm happy to go through that really quick. Questions? All right.
Hello.
There you go.
I'm not sure if you heard the question. So just your comments or opinions or thoughts on floating debt, bridge debt that's going to be coming due in the next 6-12 months. Do you think that is going to be to the degree that it'll destabilize multifamily?
It could. It depends on what government pushes are there, right? So yesterday I was in a broker's office who went to a conference that's about, what's it called? I just totally forgot. Basically, lenders that foreclose on deals. That's the whole conference. I didn't know that was a conference. I want to figure out how to get into that room. But he was saying that some of the lenders are starting to look at, hey, there are a lot of those situations, right? Like on our deals, on our floating rate debt, we are very anal right now about when those refis are due and what NOIs we need to be at to model, if rates stay where they are today, and track it month over month on how we're going to get there. Right, you really have to be very militant because right now that number has changed significantly than we bought the deal. So you really have to micromanage it. And the problem is you have some deals that some people have that are due in the next 6 months, right? And so if those guys are already off, what's the lender going to do? Foreclose? Well, the lender doesn't want to foreclose. And they're explaining that the lenders were talking to them that they're starting to get creative on the structuring, right? And so let's say you have a deal that you bought, I'm just going to make up numbers. You bought it for $60 million. It has a $40 million loan, right? Well, now that lender, maybe that deal with the current NOI, what's going on in the debt market, that might refi out at a $35 million loan in fixed rate debt, best case, right? Well, so there's a $5 million gap. So either the owners need to bring $5 million, or it sounds like what the lenders are starting to get to is saying, look, we'll let them refi out into the best fixed rate debt they can find, so they get that $35 million loan. That $5 million that's left, they'll deploy into the deal as pref, and then the owners sit on top of that. So at least from the lender's perspective, they're not having to take back the deal. It's not getting screwed over. Then from the owner's perspective, also they didn't have to give it up to the lender, but obviously the lender's money is sitting there in pref. And so I think there's going to be a lot more creative structures happening, and it's just about ultimately what triggers as a government open up for some of those scenarios, right? Because you did hear, I think was it last month or the month before, where the government's trying to say, hey, lenders, you need to start to figure out ways to work with people because, yeah, there's a lot of concern. And I'm seeing that in deals that brokers are bringing us today where they have to make a decision, they're kind of in a bind, and they're selling them at a discount. There's a lot of those. We've seen no less than 15 of those deals probably in the past 30 days where essentially the basis we could buy it at is below their loan amount. Like the lenders are pretty much done with it. Sellers are going to lose all their equity, and so you have to kind of work through that.
Thank you.
Any more questions? All right, over here.
Cap rates are softening.
Uh-huh. That's a good question. I wish I had a crystal ball. So the question is, cap rates are softening. What do you model in for your cap rates on the exits, right? And again, it's very market driven, right? Some markets still have tremendous demand, but cap rates have softened. Now, interest rates being 7%, I'm not modeling a 7% exit on these deals, right? I think, once things settle down, I think cap rates will decompress, but I don't think it's going to decompress to the way your rates are, right? Because right now you have an inversion, right, where your rates are higher than cap rates. But again, multifamily is still a very attractive asset class. And so that gets back to the conversation of, well, maybe the norm becomes people just buying lower leverage deals to where your total cost of capital is still below that cap rate. But ultimately for us, if we're looking at A-class product, we're in that 5.5 to 6% exit caps, right, on newer stuff. Instead of, in some of the primary markets, some of the B products, kind of, again, 5.9 to 6.25. It depends on kind of the market and what's going on. But that's a very hard answer. That's where I tell people it's about really modeling out your capital stack I talked about earlier and making sure you have the time, you have the resources to be able to work that deal and get the yield that you're looking for. All right, one more. Insurance cost projection, this one's awesome because 4 years ago in Houston, what were we underwriting insurance costs at per door? Martin, yeah, even that's on the high side. We were underwriting $500-600 for insurance 4 years ago in Houston. Now that number is, that's on the low side. He's conservative. That number is like $1,500-1,600. So, yeah, it depends on where you are. So insurance is tough, and again, it's very market driven. Houston is very different than Galveston, which is very different than Dallas. But it's tough. You got to understand your markets. Talk to brokers. Go get actual quotes. So I'll do one last one and then call it a day. All right, last question. So I'm already over at time. Going once, twice. All right. Well, thank you guys very much. I will be outside an hour, so feel free to come talk.